Finding steady income in today's market feels like searching for a needle in a haystack,
Yeah.
Especially with, well, everything going on. Like, anyone else see those headlines out of the Middle East and think, oof?
It's a natural reaction. When everything feels uncertain, you look for solid ground, something reliable.
Totally. And it seems like a lot of investors are turning to dividend stocks. But man, trying to sort through all those companies to find the real gems, it's overwhelming. That's where the pros over at TipRanks come in. They track which analysts, the Wall Street kind, have the best track record. It's like they have a crystal ball.
Think of it more like informed decision-making. TipRanks gives you insights into who's consistently making predictions that match what actually happens in the market.
Right. That's super valuable. And they've got some analysts really high on AT&T, the telecom giant. They've got that dividend history, and right now it's sitting at 5.2%?
5.2% yield, that's right.
And Ivan Feinseth, he's an analyst at Tigers Financial. He is particularly bullish, even went so far as to raise his price target on AT&T. So what's got him so hyped?
He's seeing really strong fundamentals. Their Q2 earnings were impressive, especially in their wireless business. They pulled in almost 420,000 new customers.
Wow.
And not just any customers, postpaid. So those are the ones with contracts.
So reliable income.
Exactly. And their churn rate, the percentage of customers ditching their service crazy low, only 0.7%.
So people are sticking with them, which is a good sign, right?
Absolutely. On top of that, they've been steadily growing their fiber optic network. They've added at least 200,000 fiber subscribers every quarter for 18 quarters in a row. And Feinseth, he sees that momentum continuing, especially with the 5G rollout and, everyone wants the latest iPhone.
And it's not just growth, right? They're also tackling their debt, which is music to investors' ears. So AT&T, solid performance, that dividend history, and big plans for the future. It's checking a lot of boxes.
Now, what if you could get a dividend paycheck every single month? That's Realty Income.
Wait, monthly? Every month. Okay, I'm listening.
And they just declared another one, October 8th. That's 0.2635 hours per share, payable November 15th.
Coming up soon.
And with a 5.1% yield, definitely catches your eye.
Definitely. So tell me more about Realty Income. Why are analysts so high on them?
RBC Capital, Brad Heffern over there, he's particularly optimistic about Realty Income. He even raised his price target on the stock recently. He sees those lower interest rates as a big win for REITs in general, but Realty Income in particular.
Now, I'll be honest. Sometimes the why of the financial world kind of goes over my head. Why exactly do lower interest rates make REITs more attractive?
It all comes down to how REITs operate. Remember, they own and manage properties, and that often means borrowing money. Debt. Right. So when interest rates are lower, it's like getting a better mortgage rate. Their borrowing costs go down, which means more profit.
So more money for them ultimately means potentially more money for investors like me. I get it. And what makes Realty Income, specifically, stand out?
Well, Heffern, he points to their net lease portfolio. Basically, it means their tenants are responsible for most of the property expenses, which means more predictable income for Realty Income.
I like predictable when it comes to my income.
Exactly. Plus, a lot of their tenants, they're publicly traded companies themselves.
Oh, so you look them up, see how they're doing.
Exactly. Adds a layer of transparency and stability. So you've got AT&T, it's a telecom giant. You've got Realty Income paying those monthly dividends. What's next on our little dividend deep dive? Let's talk about a company that might surprise you.
Okay.
McDonald's.
What McDonald's? Like the Golden Arches McDonald's.
The one and only.
I mean, I know they serve up Happy Meals, but dividends.
They do both. And they've actually been increasing that dividend for 48 years straight.
48 years. Wow. Okay, so they're serious about this whole dividend thing.
Oh, yeah. They've earned that dividend aristocrat title. It's a pretty exclusive club.
Okay, I'm impressed. Their current yield is only 2.3%, is that right? Is that really something to write home about?
Here's the thing, that 2.3% yield, you got to look at it in context. Their history of dividend growth, their overall financial strength, it all factors in.
So it's like that friend who always shows up, right? Dependable, always there for you.
Exactly. And McDonald's, they're nothing if not consistent.
True that. So they're reliable, but what makes analysts think they'll keep this up? Especially with the economy being kind of,
Right. Well, Baird analyst David Tarantino sees some really positive signs. McDonald's U.S. comparable sales growth is looking good.
So people are still craving those Big Macs.
Seems so. Tarantino actually revised his Q3 estimate. Initially, he predicted like a 2% decline, but now he's saying 0.5% increase.
Wow, that's a pretty big swing. What changed?
Well, that $5 meal deal has been hugely popular.
Can't beat that price.
And then their collector's meal, you remember? Created a lot of buzz, sold out super fast. Plus, they're up against easier comparisons from last year, so the growth looks even better.
Smart. So they've got the U.S. market figured out. What about internationally?
That's a bit more up in the air. The global economic picture is definitely impacting their performance in other markets.
Makes sense.
But even with that uncertainty, Tarantino actually increased his overall earnings per share estimate for McDonald's, largely because of how strong the U.S. business is.
Interesting. Okay, so we've got AT&T, Realty Income, and now McDonald's. All totally different companies, all on the radar for dividend investors. Goes to show there's no one right answer is there.
Nope. And that's exactly why it's so important to look deeper, beyond the headlines. Really try to understand what drives a company's ability to pay those dividends and keep paying them.
Which brings up a question. We keep talking about what analysts are saying, but there's so many voices out there. How do you know who to listen to? How do you cut through the noise and make good decisions for your own portfolio?
It's a bit overwhelming, right?
Totally. So many voices, so many opinions.
Well, it's all about asking the right questions, I think. You can't just blindly follow what one analyst says, right? Even the seasoned ones.
Right. They're not always real.
Exactly. Think of their insights as a starting point, a way to kind of focus your own research.
So do your own homework. Don't just take their word for it.
Exactly. You want to be confident in your own decisions, right? Build your own conviction.
Absolutely. So it's like having a map instead of a GPS.
I like that.
You still need those map reading skills,
Yeah.
To really navigate and reach your destination.
I love that analogy. It's about the journey, not just the destination.
Well said. So speaking of journeys, how do your own personal financial goals play into all of this? Like, is it all about chasing the highest dividend yield?
Not necessarily. It really comes down to aligning your investments with your overall plan. Like, what are you actually hoping to achieve? You looking for income today, growth in the future, or a little bit of both?
Right, because everyone's different.
Exactly. Someone nearing retirement, they might want that stability, consistent income more than someone with a longer time horizon.
They're playing the long game.
Right. They might be okay with a bit more risk for the potential of bigger payouts down the line.
Makes sense. So it's all about finding that sweet spot, that balance between risk and reward.
Exactly. And that sweet spot, it's different for everyone.
So we've talked about why dividend stocks are attractive right now. We've dug into a few specific companies analysts are excited about and even how to think about your own research process. But what about the actual nuts and bolts of evaluating a company? Like, are there any red flags we should be looking out for?
Absolutely. You always want to make sure the company's financials are healthy, like their earnings per share or EPS.
Earnings per share, that's basically how much profit they're making.
Right, for each share of stock. So if their earnings are consistently growing, that's a good sign they can support and potentially even increase those dividends.
So consistent earnings, good. What about debt?
Another big one. High levels of debt can be a red flag, especially if interest rates are climbing higher.
Makes sense. Like having those high credit card balances, not ideal.
Right. You want to look for companies with manageable debt and a clear plan for paying it down.
So they're not in over their heads.
Yeah.
Got it. Okay, this is starting to feel like detective work. Where do we even find all this information?
Well, we've talked about tip ranks, but there's a ton of resources out there. Yahoo Finance, Google Finance, even good old Bloomberg.
So much information.
Right. You can spend hours digging into all the data. Dividend history, payout ratios, analyst ratings.
That's a lot to process. Any tips for making sense of it all?
I think it's super important to understand the bigger picture of the industry the company's in.
So not just the numbers, but the story behind them.
Exactly. Like, is the industry growing or is it facing big challenges?
Like from new technology or even just changing consumer tastes.
Right. A company in a fast-growing industry, especially if they're a leader in that space, they're usually in a better position to grow earnings and dividends over time.
Compared to, say, a company in a shrinking industry, even if that company's offering a high dividend yield right now.
Exactly. It's about looking beyond that immediate payout and considering the long-term potential.
Love that. So it's a bit like that saying, don't just fish for the day, learn to fish for a lifetime.
Right.
Perfectly said. You want to invest in companies that can adapt and thrive as the world changes, not just those offering a quick payout.
That's some solid advice. So we've covered a lot of ground today. We talked about why dividend stocks are so popular right now, dug into a few specific companies, and even explored how to approach your own research. What's the biggest takeaway for listeners just starting out on their dividend investing journey?
Don't be afraid to dive in. There's a whole world of income-generating investments out there.
It can feel intimidating, but you don't have to be a financial expert to get started. Exactly. Start by figuring out your own goals, your risk tolerance, do your homework, and remember, there's no one right way to do this. It's about finding what works best for you. And don't be afraid to seek help along the way. A financial advisor can be a great resource, like having a guide on your investing journey.
I love that. It's your journey, your portfolio.
Yeah.
So find what works for you. This has been awesome. I've learned so much. Thanks for breaking it all down.
Anytime, always happy to chat dividends.
And to everyone listening, remember, knowledge is power. The more you learn about dividend investing, the better equipped you'll be to make those informed decisions for your financial future. Until next time, happy investing.